Hi and welcome. My name is Greg Smerdell. I will be your host today for this live webinar that will be discussing some pretty exciting things. With me today is Eric. So Eric, why don't you start off by telling us about your role here at Smartland?
Sure. My name is Eric Golubitsky. I'm part of the investor relations team here. Specifically, I deal with high net worth investors, family offices, other institutional investors like private equity and pension funds and so on for the bigger projects.
Okay, good. Lots to discuss. You ready?
Sure. Yeah,
All right.
yeah,
We have over 200 people that registered for this webinar, so that's
Amazing.
pretty exciting.
It's a big number.
For the benefit of those people watching, though, let's tell them a little bit about what we're going to be talking about here. So we're going to be talking about opportunity zones. We'll give an overview as to what that is. We'll talk about investing in qualified opportunity zone funds. Talk about some investments that Smartland has. Talk about some of the projects that you folks have identified. I'm going to ask you why why we should invest with your company, Smartland. That'll be one of the things.
Right.
So prepare yourself for that now. And Northeast Ohio, why is that a good place for us to invest? And then at the end, we're going to do some questions and answers. So we'll invite people to submit their questions. They'll put them on a screen in front of us. We'll be able to read those, and hopefully they'll stump you. Sound like fun?
Sounds like fun.
All right. So let's get right into it. We got an awful lot to discuss. Tell us a little bit about opportunity zones. What exactly are they?
Well, first off, opportunity zones are probably one of the biggest buzzwords in real estate investments right now.
Okay.
It's a very unique time. Who knows if it'll ever happen again? Hopefully it will because of the success. And we'd love to be part of it. But basically, opportunity zones were a tax code that was added to the Tax Cuts and Job Act of 2017.
Okay.
So basically the U.S. government and each state went around the U.S. and designated 8,700 communities across the U.S. as opportunity zones. So these zones were selected to incentivize institutional investments into these local communities. Many of them are lower income and underserved, but at the end of the day, the tax code and the effort are tools to incentivize the economy as well as the social impact.
Okay. Nice little definition you just gave of anything else we should know about opportunity zones?
Yeah, what's important is that not all of opportunity zones are underserved. There are select areas and projects that are very exciting, and of course the super underserved are areas and projects that we will not touch, and even with added millions, it would take a lot more to benefit those areas.
Sure.
But there's a lot of opportunity zone specific areas and projects that are exciting and definitely worth the look.
Okay. So tell me then, let's talk about these opportunity zones. Why would someone want to invest in one? And what are some of these incentives that you
Sure.
about?
So we're going to put a little graphic on the screen, but
Okay.
number one is social impact, right? So I touched on that for a second. These are made longer term investments to help these areas and economy and people and so on.
Okay.
And then of course why we're all here is the material tax benefits that investors will see. So the first one is the deferring of the federal capital gains that the investors have earned, and it's deferred till 2026. So that's a long time that
Right.
you don't have to pay taxes on it. And that's for anything from stocks to bonds, annuities, real estate, 1031 exchange, Bitcoin or other cryptocurrencies, selling a business or part of a business. That's all part of capital gains.
Okay.
The other bucket is to reduce these federal capital gains. So the longer you hold, the more you can reduce these capital gains over time. And then the last...
And you can reduce those up to what?
Up to 15%.
15%.
Up to
Okay.
15%.
Okay.
And then you can also pay up to zero tax on any future gains of investments in opportunity zones if you hold them beyond 10 years.
Okay. All right.
And, one more thing.
Oh, I don't want to step on you. I'm sorry. Go ahead.
So what we're seeing on the underwriting as we're looking at these projects, it's really exciting that over 10 years, not only will the value of this property double, but the investments are looking like they'll double. They'll 2x what they would have made elsewhere.
Okay. Well, we talked about the 15%. You mentioned the 10 years. They hold it up to 10 years.
Yeah.
So what if an investor doesn't hold the investment up to 10 years? Then what?
So we're putting another graph up. So obviously the best case scenario and the best benefits is if you hold the investment for 10 plus years. If you hold it up to 5 years, the benefit is still the deferring of the capital gains.
Right.
If you hold it for 5 to 7 years, there's a 10% exclusion of the deferred gain. If you hold more than 7 years, the 10% becomes 15%.
Okay.
And then the goal is to have great projects and a 10-year hold for maximum benefits. So if you look at this last chart, with $1 million investment, a typical real estate fund will return a little over 2x over a 10-year period. This is 3x. So the 1.3 million, what they typically see in returns, is now slated for 1.8 if they hold on to the 10 years.
Gotcha. All right. Well, you mentioned something about certified, qualified opportunity funds. Tell us about that then.
Sure. So basically, the Qualified Opportunity Fund is an investment vehicle as a corporation, set up as a corporation or a partnership with the purpose of investing in qualified opportunity zone projects.
Okay.
So the fund must be a U.S. legal entity that files its own tax returns, and it can either be a single asset fund or a multi-asset fund.
Okay, and we'll talk about those a little bit later on. All right, how do you become a certified opportunity fund itself? How do you become certified?
Yeah, so there's definitely complications on setting up the fund and doing that correctly. So you need to work with attorneys and accountants.
Sure,
and we're doing that currently. But for the investors, it's a couple simple criteria. One is eligible taxpayer. Number two, none of the projects need pre-approval by the IRS.
Okay.
As long as we abide by the guidelines, we're good. And then third, the taxpayer just completes a simple form and adds it to their yearly tax.
I gotcha. All right. So timing then, let's talk about that. When would I have to invest to get all the benefits?
Sure. So the guideline for investors is that you have to invest your capital gains within 180 days. It can be some of them. You don't have to invest all of your capital gains.
Right.
It can be a percentage of, but you have to do it within 180 days.
Right.
And the deadline as of today still is the end of the year.
12/31/2019. Okay.
We're hoping that they may extend that, but as of right now, it's that.
That's where it's at.
Another guideline is that 90% of our investments and projects are in qualified opportunity zones that are in the fund.
Okay.
Another important point is that we have to, as the real estate owner-operator, deploy the capital within 30 months. So we have 30 months to complete these projects.
Okay.
And the last point is that for a project to qualify as a qualified opportunity zone project, we have to put at least the amount of money that we acquired the property for. So if we acquire property and maybe an older building for $1 million, you have to put at least $1 million into it. So we have 30 months to do that.
Gotcha.
To qualify.
I gotcha. All right. Well, except maybe for marriage, they always say there's an exit strategy for everything in life, right?
Right.
I'm guessing there's one for qualified opportunity zone funds as well.
Yeah. So the big difference is the 10-year hold, right? So other private equity type funds, the holds are as quick as a few years, 3-4 years, to as long as 10 plus. This one's definitely 10 is the holding period. Also, tax forgiveness for any gain in a qualified opportunity fund investment is available only if the investor sells their interest in that qualified opportunity fund. Means at exit. If an investor holds their interest for that full 10 years or longer than the 10 years, then the investor elects to basically what's called step-up basis at fair market value. So at 10 years, whatever that value is at market, that's the value assessed at the time, and the delta from what we invested in and what they made, they don't have to pay any capital gains taxes.
Okay. Well, you always want to be on the right side of things, right?
Yep.
So talk to me about details and legal guidance. Are those all finalized by the government?
They are not. They are not. So yeah, they were supposed to be about a month ago, but we all know that there was a government shutdown for a little bit, so it's delayed things. Again, Treasury and IRS, as we know from what we've heard and know, they're finalizing right now. So we expect final details in the next few months, but that's not slowing down or stopping any opportunity zone projects from moving forward. It's just some I's need to be dotted and T's crossed. And so
I gotcha. Well, we teased it a little bit earlier at the start of the program. Let's talk now about the differences between the single and the multi-asset funds.
Sure. So single asset has one project or one property in a fund. Multi-asset have multiple. So single
makes sense, I guess.
multiple projects. So the single asset investors are typically part of the decision process on go no go, and it's usually a process of where we identify the project, we create the underwriting, we put a contract in place, we go get investor money, and that all takes a lot of time. Also, if an investor invests in multiple single asset funds, it's multiple contracts, it's multiple reporting, it's anyway, it just adds on versus and there's no diversification, right, in a single asset fund. So if, God forbid, there's an issue with the property, then that ruins the whole investment. So no diversification. The multi-asset has multiple properties in it. What's also neat about multiple asset funds is that there's shared resources. And then opposite of what I was saying, as far as taking time, the cash is already there. So you can deploy very quickly. You can buy properties quickly before other competitors come in.
So speed is the key word there.
Speed is key, especially with opportunity zones where there are deadlines to deploy and whatever else. And there's so many projects that if we just kept going back project by project basis, that would slow us down. And we want to speed things up, and we want to be as efficient as possible. And we think that will bring the best investor returns and so on. So yeah, speed and deployment and being able to buy right and efficiencies really make sense to us. Not to mention we're completely aligned with the investors. It's our money as well. It's our time. It's our reputation. We want nothing but to bring the best returns to our investors and the best projects.
Okay, well, let's talk about that then. I don't think you would invite 200 of our closest friends to the webinar without having some sort of projects to announce.
Exactly.
Would I be correct in that assumption?
You are correct.
Okay.
Yeah. So
let's talk about how much. We probably have more than one. Let's talk about the first one.
Okay. So I do want to mention that we have many. These are three that we've absolutely recognized that we want to move forward with. And
after having sifted through several.
Some might not be in the best area. Some might want too much money because they consider themselves in an opportunity zone and trying to take advantage of it. These are three great opportunities. The first one is downtown Cleveland, right on the river, and it's 40 apartment units. The acquisition price is around $2 million. We want to put about $6 million into it. And again, there's a lot of restaurants, a lot of construction, it's in the flats area, so that's really exciting. And there's an opportunity where we can turn a couple sections of the building into a 2-story restaurant with outdoor patio and
cool.
club and think Miami style type restaurant, and invite potentially a partner chef into the deal and so on. So that's
cool.
exciting. Yeah.
All right. I understand one of these is located in Euclid. Am I right about that?
You're right. So east side suburb,
right, of Cleveland.
Of Cleveland. Right. There's a main highway that runs through it, and this 3-acre property is right off the highway, right near a brand new Amazon fulfillment center as well, right down the street. So also great deal. So $500,000 acquisition. There's an older building on it that definitely needs some love, and an opportunity for an industrial type project. Warehouse type, so we've identified a sports complex needed in the area, and so that's a fun project, and it's right off the highway as well.
Cool. Yeah. Is there a third? I don't want to put you on the spot, but
there's
is there
a
another
third.
one?
There's a third.
Right.
There's a third. So again, like I said earlier, there's good places for opportunity zones. There's not so great places that we're staying away from, and because we know the area so well, that's why it's important. We've seen owner-operators, for example, out of New York City, that are saying they're going to deploy in Seattle and Phoenix, and they don't know those areas like we know this area. So the third, which is in a great area, is off of a street called East 55th.
Right.
So 55 streets east of Cleveland, the center of Cleveland. But what's cool, it's a main artery between 2 major highways, so 77 and 90, and a lot of traffic, a lot of street traffic, and it's being rebuilt. So there's actually a new brewery there.
I know what you're talking about.
Yeah, exactly. So this is a 13,000 square foot parcel with a couple buildings on it that we would tear down.
Right.
So prime for a brand new warehouse type structure with office on the second floor, and potentially, because of so much traffic, some retail up front. But 3 absolutely exciting projects.
Sounds great. All right, so I've got some money. I want to invest in these projects. How do I do it?
How do you do it? So what we've actually done, and because of the similarity of these projects, and because it's all in the vicinity, and these are projects that we know inside out on how to execute on and so on, we're combining them into a fund. So it's a $22 million is the combined total project scope will be the fund, and so 1/3 or 30% is going to equity. So we're raising $6.6 million from investors for the fund, and $15.4 million will be the debt that we have great relationships with banks on the debt. So which we'll use as leverage, but the $6.6 million we're raising in equity. We anticipate positive cash flow as soon as the construction's done on all 3 projects. So that's going to be 7 years of cash flow and quarterly dividends for investors. Not to mention, we feel it'll double in value in the next 10 years. All these projects, and the minimum investment into this fund is $250,000.
Okay. All right. Well, I warned you. I told you it was coming. I'm going to put you on the spot.
Sure.
As an investor now, I got some money. I want to invest it. Why am I giving it to Smartland?
Great question.
Thanks. I wrote that myself.
So we're a value add, fully integrated owner operator in the Midwest, in Northeast Ohio. So by fully integrated, we've spent 10 years transitioning over 2,000 doors. And at that same time, everything's in-house. So we don't sub out construction. It's in-house. Design, engineering, architecture is in-house. Property management, marketing. So full marketing department to find tenants for our properties and so on is in-house.
Okay.
And investor relations, so hand-holding, explanations, reporting. We're super proactive and have an amazing relationship with our existing investors. We put top of the line amenities into our units. So all of our units, hardwood floors, new paint, new cabinets, stone countertops, tiled bathrooms. We're so process oriented. In fact, yesterday we put time-lapse cameras into one of our projects where we are doing single-day renovations. So we're going.
Wait a minute. Now, you're renovating an entire in one day?
In one day. In one day.
Come on, seriously?
So again, it takes a big team, 14,
Wow.
14 guys, and it takes a process.
I can't even get a painting crew to do it in one day.
Pre-palletizing every part needed. The planning and the process behind it is so impressive. We're actually going to create content over the next few weeks that we're going to put out to our investors to show them how we do it.
Wow.
and so on. Technology, we put technology into all of our units. So an Alexa and a speaker and a smart thermostat and a smart light switch. And again, tenants get used to it and they love it and they don't move out.
Right. Nice.
So occupancy is important. So it's things like that we do to stay ahead of the curve as opposed to behind the curve.
Forward thinking.
Right.
And
Now we're adding electric charging stations
to cars?
To our apartments for electric cars.
Wow.
Yeah. So again, ahead of the curve versus behind the curve. We get it that a lot of our tenants don't have electric cars yet, but in the next few years they will. Not to mention, it's a profit center.
Yeah.
So they'll be open to the public to come in and for a couple dollars charge their car. All of our apartments are near the city of Cleveland or near nice areas where somebody can stop by
breweries.
Or breweries. Exactly right. But it's good. It's good PR. It's good in the next few years as people will be searching apartments with electric charging stations. We'll already have been there.
That's cool.
Yeah.
So I had an opportunity to look at your portfolio.
Yep.
And so I want to ask you if any of the multifamily projects that you've done in the past, any of those qualify as a opportunity zone project? So
we looked at a property a few years ago, and right when they announced the Opportunity Zone Fund.
Right.
So this one's too late for the fund, but it was a great test case. Okay. And we went into a 100-year-old Cleveland building. It was actually off 55th.
Where the brewery is.
Where the brewery, I knew you'd say that.
He knows his customers.
And the average rent was $450. Mm-hmm. So we put a slide up for investors to see what we did with the property. The units look amazing. I would live there in 1 second. Really fancy dog park with a jungle gym and so on. And we have a full dog program behind the scenes as well. We bought a really nice poster vinyl printer, and we put vinyl posters to create that warm look. Right. All the apartments in the area, cold, old, dark, dingy. This is warm. It's nice, and home. It's home. Yeah. And believe it or not, we have multiple tenants that now pay us $900 a month, so double rent, which is almost unheard of anywhere else. So we're proud of that.
All right. Well, you had mentioned a few minutes ago, New York people investing in Seattle and investing maybe somewhere else.
Sure.
Why would we want to invest in Northeast Ohio? What's the appeal there?
It's a great question. So again, I've lived here almost my entire life, 95% of it. I mean, year after year after year after year, Cleveland and Northeast Ohio has been recognized as a place where one of the best places to raise a family because of affordability, because of seasons, because of our schools. We've got all the major sports team. We've got a huge body of water in Lake Erie. The city is going through a renaissance. The companies that we have in Cleveland are top notch. We have Progressive Insurance and Steris and Lubrizol and the top medical systems in the country,
Right.
the Cleveland Clinic,
Right.
and university hospitals
Right.
in our backyard, which is amazing. 2 health systems. We have just a plethora of things to do, and Rock and Roll Hall of Fame, and museums and arts, and it's just a great city. And for
Right.
real estate investment, like I said earlier, it's hard to find a lot of upside and cash flow. So you can go to New York or Miami and lose a lot of money until you make some, hopefully with some appreciation over time.
Sure.
We have consistent appreciation and consistent money makers and so on. And you know this area well.
The city should hire you as their marketing person, I'll tell you.
Yeah.
So are you up for some questions?
Sure.
From,
Yeah.
we've got, just to kind of give people a peek behind the curtain here, we have a screen where our tech people are able to throw up some of the questions that people have typed in during the course of the last several minutes. So we've got some of those here, so I'll just read some of those and see if we can stump you.
Sounds good.
My guess is we can't, but we'll give it a shot.
Okay.
All right, so here's one. How can I view more opportunity zones?
How can I view more? So there are maps online. What's very important is that you cross-check. So I recommend if you're going to Google the state you're in. So
Right.
for example, Ohio
Right.
Opportunity Zone map, and find it that way through Google, right? Also, the U.S. Treasury has the map. So
Okay.
I highly recommend cross-checking. We've seen and caught mistakes on some maps. So it's really important not to make that mistake and think you're in an opportunity zone and then you're not.
And you're not. Okay.
Right.
Next question that just came up to us. How are opportunity zones different from a 1031 exchange?
Opportunity zones different from a 1030.
Yeah.
Okay, so 1031 exchange, the biggest difference is that you have to invest the entire amount into that next investment, where with opportunity zones, it's completely discretionary. Whatever capital gains you want to invest is up to you, and you don't need an external intermediary that you do in a 1031.
Okay. All right, let's see. What do we got next? Oh, well, here's somebody that wants to look at maybe it's a negative Nelly asking this one. I'm not sure. Are there any critiques of opportunity zones? There's got to be a downside, right?
Yeah. The 10 years, right?
So the holding period.
The holding period.
Right.
So
okay.
it's hard. Again, I think the scope of projects make it exciting to worth the wait. Besides the projects, it's the incentives that they're making, and again, the third is the social impact. So I think combined of all those three, you can look at it as, I got to park my money for 10 years, but the incentives, I think, are there.
Okay. All right. Next question. Well, actually, we talked about this before, but I think maybe since somebody's asking it again, let's talk about it again if you're all right.
Sure.
Somebody's looking for the benefits of multi-asset funds versus the single asset.
Okay, so we talked about it before. I'll recap it quickly. Again, this is going to be available to everyone. We're going to email this video back, along with these questions and answers. But again, the biggest difference between single asset and multi-asset is one separate fund that has one property or project in the deal versus one that has others, that offers diversity and so on. Okay. The worry is if we give you guys a lot of cash, you'll spend a lot of cash, but I couldn't disagree with it more. We're completely 100% aligned with our investors. We have not only our money and time on the line, we have our reputation.
Sure.
We want our investors to be with us on many, many more projects down the road.
Sure.
And the speed to market and the speed of deploying and the speed of execution way outweighs any of this worry or whatever else.
Sure.
So we're big fans, especially for opportunity zone funds, to do the multi-asset deal.
Okay. What do we got, Tim? Next question. Here we go.
The vehicle.
Yeah, how is this program not just a vehicle for gentrification?
Yeah,
and I said that on the first try right.
That's a great question. So what's great about it, and that was actually one of our first questions, was okay. What's
one of your first questions?
One of ours as a team
right,
was okay. What are they going to make us do? Do we have to hire City of Cleveland employees? Do we have to pay them certain wages? Do we have to have specific minorities or whatever that you do in many municipality type incentive projects? With this, nothing. So we can use our own crews. We can pay them what we typically pay them, and that enhances the projects and not limits them, which is important.
Let's see. Can an opportunity fund make investments in multiple opportunity zones?
Sure, of course. So again, like I said, we really know Northeast Ohio, and especially with opportunity zones that require heavy lifting and construction, and it's not just repainting a building and charging more rent.
Yeah.
This is you're rebuilding projects and so on. You can invest, basically. And so can we. So if the right project comes along and it's in Columbus, we're going to be super careful and whatever else. But yeah, we absolutely can, in this same fund, invest in other opportunities.
So the simple answer is yes.
Yes.
Okay.
I don't give simple answers.
All right. Can an investor invest directly into an opportunity zone business to qualify for associated tax incentives?
So no, they cannot. So it's got to go through a fund. Okay. It has to be properly set up. Again, you need legal and accounting advice, and you can't just buy a building and think you're good to go.
Right.
It has to go through a fund.
Right. Okay. Are there minimum or maximum investments? Is what one person wants to know.
For opportunity zones in general, no. For our fund, there's a minimum of $250,000.
Okay.
We're just looking for the right amount of partners.
Okay. I think that may be the final question that we had submitted. Anything else you wanted to add?
No, I'm good. I'm excited about these projects. I'm excited that we had 200 registrants, which is amazing and a big number. So look forward to speaking with you. And by all means, you can email me at eg@smartland.com or call me. Direct line is 216-470-9088. And we will this week send a follow-up email with this.
And that was eg@smartland.com for the email address.
eg@smartland.com.
Okay. All right. Well, I appreciate it. Thanks so much for your time, Eric.
Sure.
And I want to thank all 200 people that registered and watched our webinar today on opportunity zones. Any questions we didn't get to, and there might be some questions submitted after we sign off the air here, we'll be answering those and emailing those along with the replay of this webinar. We just asked you to give us a couple of days to do that, but we'll do that.
Sounds good.
Cool.
Sounds good.
All right. I appreciate it. Thanks, everyone.
Thanks, Craig. Thank you.
Appreciate it.
All right.